Imagine you walk into a bank. You sit across from a loan officer, hand over your documents, and 30 minutes later, you are approved for a $300,000 mortgage. You shake hands, you leave. Here's the question most people never think to ask: where did that $300,000 come from? The instinctive answer is obvious. The bank had it. Depositors put money in, the bank held it, and now it lends some of it out to you. A simple transfer. Money moves from one place to another. That answer is intuitive. It is also fundamentally incorrect. And understanding why it is incorrect changes how you see nearly everything about the modern economy. The model most people carry in their heads is called the deposit lending model. Banks collect deposits. They lend a portion of those deposits out. They keep a fraction in reserve. Simple, logical. This is how banks were once described in textbooks. It is how most people, including many educated professionals, still imagine banking works. But central banks around the world, including the Bank of England, have explicitly stated that this is not how modern commercial banking actually operates. This is not a fringe position. It is documented and officially acknowledged. So what actually happens when a bank issues a loan? The bank does not reach into a vault and transfer existing funds to your account. It opens a spreadsheet, conceptually speaking, and types in a number. It credits your account with $300,000, and at the same moment, it records a corresponding liability on its own books, a promise that you will repay. The deposit was not transferred, it was created. This is called credit creation, and it is the foundational mechanism of the modern monetary system. When a bank extends credit, two things happen simultaneously. Your account shows a new asset, money you can spend. The bank shows a new liability, debt you owe. These two entries cancel each other out on paper, but from the perspective of the economy, something new has appeared. Purchasing power that did not exist before now circulates. Loans create deposits, not the other way around. This is the first major reorientation. Most people spend their lives thinking that saving comes before lending, that someone's prudence funds someone else's mortgage. But in the architecture of modern banking, the loan comes first. The deposit follows from it. At this point, a reasonable question emerges. If banks can simply create money by issuing loans, what stops them from doing it infinitely? The answer is constraints, real, binding, structural constraints. Banks do not operate in a vacuum. They are required to hold capital, real equity, as a buffer against losses. The more loans they extend, the more capital they must maintain. Capital does not appear from nowhere. It must be raised. It must be earned. It represents genuine financial exposure. Banks also face liquidity constraints. When the money they create circulates and ends up at other banks, which it always does, those banks will demand settlement. That settlement requires actual reserves held at the central bank. A bank that creates credit recklessly will find itself unable to meet those obligations. So the system is not unlimited. It is constrained by regulation, by capital ratios, by market discipline, and by the basic mechanics of interbank settlement. The ability to create money is real, but it is not infinite, and it is not free. This is not a loophole, it is the design. Modern economies are credit economies. They are built on the assumption that credit will expand over time. The ability for banks to create money through lending is not an accident of deregulation. It is the mechanism through which economies scale. A construction company needs capital to build a factory before that factory generates revenue. A startup needs funding before it produces a product. A family needs a mortgage before they can own a home. In each case, the money must exist before the productive activity it funds can take place. Credit creation solves this sequencing problem. It allows economic activity to happen now, financed by the expectation of future value. This is why the system is structured this way. Not because of greed, not because of conspiracy, but because growth, the kind that creates jobs, infrastructure, and rising living standards, structurally requires access to credit that does not yet exist. The central thesis, stated plainly, money is not found. It is created in the act of borrowing. Now extend that logic across the entire economy. When credit expands, when banks are lending freely and borrowers are borrowing confidently, the total supply of money in the economy grows. More purchasing power circulates. More activity is financed. More transactions occur. When credit contracts, when banks tighten their standards, or borrowers stop borrowing, or loans go bad, the money supply shrinks. This is not a metaphor. The money that was created by lending disappears when loans are repaid or written off. Repayment destroys money. When you make your final mortgage payment, that $300,000 you borrowed does not return to some pool of savings waiting to be lent again. It disappears. The liability is extinguished. So is the asset that created it. This is why economies depend on continuous borrowing, not because lenders are manipulative, but because the money supply itself is a function of outstanding credit. When borrowing stops, the fuel stops. When borrowing reverses, the engine runs backward. Think about what this means for economic cycles. Credit expansions feel good. Money is available. Investment flows. Employment rises. Asset prices climb. Confidence builds on confidence. Credit contractions feel brutal. Money tightens. Investment stalls. Businesses cut costs. Asset prices fall. Confidence collapses on itself. These cycles are not simply caused by psychology or policy failure. They are baked into the architecture. Because the money supply is tied to credit activity, expansions and contractions in lending directly shape the experience of the real economy. The boom is not just a mood. The bust is not just fear. They are opposite sides of the same structural mechanism. This also illuminates something else: why debt tends to trend upward over time. In a system where money is created through lending, sustaining economic activity requires sustaining credit growth. An economy that stops borrowing does not simply stay the same. It contracts because the money supply itself begins to shrink as old loans are repaid and new ones are not issued to replace them. This creates a structural pressure toward increasing debt levels over long periods. Not because any individual agent is being reckless, but because the alternative, broadly contracting credit, is something the system finds deeply uncomfortable. Policymakers respond to credit contractions with urgency precisely because they understand what credit contraction does to the money supply. This is not a moral observation, it is a description of the architecture. Now connect this to the previous question, the one that started this series. If money loses purchasing power over time, and if money is created through credit expansion, then inflation and debt are not separate phenomena. They are twins. A growing money supply, the product of expanding credit, does not distribute its new purchasing power evenly. The new money enters the economy at specific points, through borrowers, through banks, through asset markets. By the time it diffuses broadly, prices have already adjusted. The people who access new credit earliest are positioned differently from those who hold cash and wait. That asymmetry is not a bug. It is an emergent property of a system built on credit expansion. So what should a thoughtful person do with this understanding? First, abandon the image of money as a fixed pool. It is not. It expands and contracts based on lending behavior across millions of institutions and borrowers. The money in your account is not sitting in a vault somewhere. It is the residue of someone else's debt. Second, recognize that debt is not simply a personal failure or a moral weakness. In the structure of the modern economy, debt is the mechanism through which money is brought into existence. That does not make debt consequence-free. It does make the common cultural narrative that debt is inherently shameful and that saving is always virtuous an incomplete picture of how the system actually operates. Third, understand credit cycles as structural phenomena, not random events. When credit expands broadly, the conditions feel good for reasons that have nothing to do with wisdom or discipline. When credit contracts, the conditions feel painful for reasons that are equally structural. Systems level awareness does not remove the risk, but it does replace noise with signal. Here is what the modern monetary system actually is. It is a credit architecture designed to facilitate economic expansion by allowing banks to create purchasing power in the act of lending. It is constrained by regulation, capital requirements, and the mechanics of settlement. It is not unlimited, but it is also not a simple transfer of pre-existing funds. Money is created when credit is extended. It is destroyed when credit is repaid. The money supply is, at its core, a measure of outstanding debt. And that reality, once you see it clearly, makes almost everything else about modern economies easier to read. The wealth of nations is, in significant part, a record of borrowed promises, not a condemnation, not a cause for alarm, just the architecture visible at last.